Welcome back to another quick stock analysis, and today I'll be looking at Lumen Technologies.
I'm amazed how many people own stocks. I'm amazed how many people own stocks.
Welcome back everyone, my name's Paul, and today by popular request I'll be looking at Lumen Technologies. Now Lumen Technologies looks like a kind of weird one. It looks like people have really been suggesting this to me because of this massive 7.61% dividend. This is quite a big old dividend yield that you could be getting from this company. Lumen's website is very confusing. It's very hard to really understand what it does. It just shoves up a lot of pictures to you and tells you how reliable and smooth everything is. But I think it's an internet connective company, kind of like IBM, but I think it kind of lays the cables for the internet. It's really the reason, or one of the reasons why the internet exists, but it really seems to have changed its narrative here. Its website is all about the fourth industrial revolution and data-driven innovation, and it's really gone Cathy Wood on us. It's really using that different type of marketing. So I understand why people are interested in this company and they want it looking at. On the website, it also shows lots of really big companies that are using Lumen's technology. Salesforce, you've got Zoom, and then there's just loads of really racially diverse and gender diverse photos, which don't really mean a lot. It's really hard to understand what this company does, if I'm honest, straight from its website. And I haven't looked at this website yet. This is just me going through it now. There's a lot to this company, I guess. But what we do see from Lumen Technologies is we've got a big dividend yield at 7.61%. So this is an old technology company or information technology company. And what we can see for certain is that this company is losing money. But even if a company is dying, it's still worth something. We've got to remember that. So if this company is still producing cash, and over the next 30 years, it's still going to produce that cash, and eventually it's going to give you, like, I don't know, £30,000 or something like that, that business is still worth something. So you could figure out that if this company is going to give you 30 grand over the next 10, 15 years, would you be happy paying 10 grand for that right now? I'm not sure, but the maths does work out. If this company is willing to pay you 30 grand over the next 10 years, but over that 10 years, your capital appreciation will go down by £10,000, that means you come out at a net profit of 20 grand. It's not the safest way to do things, but it is something to consider if you've got a business that is really, truly undervalued, but it is still, declining in revenue and profit. There is still going to be worth to it, so you might want to consider it as a sort of mid-term, short-term play. Anyway, what I usually look at is I look at top-line revenue growth, I'm looking at EBITDA growth, I look at justifiable debt, then I look at free cash flow. Cash flow is very, very important to me as a business. I'm into yields, I'm into dividends, and I like to know if this company is safe enough to pay off its dividends. Then I'll look at analyst estimates, and then finally I'll try and come up with some sort of valuation for this company. Right now, Lumen's current ratio is 0.44, so it cannot pay off its current liabilities. That's an exceptionally bad sign, and that would almost completely put me off investing in this business. If this business can't survive for more than a year, and at 0.4 current ratio, that suggests it can't even survive even half a year, I don't think I would be investing in it. But I'll look through it and see if there is anything interesting in the future. Share issuing is going up absolutely massively. So this is a really, really bad sign. This company cannot afford to pay its debts, and it's not only doing this through debt issuing. I'm sure it is. I haven't looked at that yet. I'm guessing there's going to be a lot of debt issuing right here, but also they're taking equity. They're taking away your stake in this company. They're making your stake in this company a lot weaker by quite a considerable amount. If we put it down to 5 years, so over the past 3 years, you've lost a 23% share in this company just through share issuing. That's not something I really like, and it's a problem I've got with growth stocks. It's a problem I have an issue getting my head around trying to figure out share issuing with growth stocks, but with old ass stocks share issuing, there is a problem there. Okay, revenue growth or lack of. Over the past 10 years, I'm going to say this is relatively flat. It's saying 15% revenue growth over the years, but it has clearly made some acquisitions in places like this and 2008, which has really grown its revenue. So I feel like this company has been making some acquisitions somewhere, and when you make an acquisition, that company that you've just brought on, their revenue goes towards your revenue, and it can often cause a big spike. It's either that or they had quite a new product in 2018, which has generally started to decline as well since that 2018. There's nothing really that looks good about this company right now. Over the 5 years, revenue growth is up 3.9%, but I feel like that's misleading because it was flat till 2017, jumped in 2018, and now it's coming back down onto a decline. I don't like the look of that. EBITDA growth does pretty much look the same, but at least this company is profitable. And it's kind of maintained that profit over the past 3 years. That's not a bad sign. I mean, it doesn't make up for the rest of it, but at least this company is profitable. It's something to think about. Next, I want to look at justifiable debt, and as rightly predicted, this company's debt is going up. It started trying to pay it off in 2020, but something tells me with how little that debt payoff was, it was about 2 billion. It feels like that was a forced debt payment, or it was a debt that matured. I can only see them with their current revenue losses and their current EBITDA, and I'm guessing their cash flow losses as well. I'm guessing that this company will start to need to take on some debt again, especially to pay for that 7.5% dividend, whatever it was. And free cash flow. Let's take a look at free cash flow, which I imagine is going to be quite positive. No, it's not. I was getting kind of excited there, but no, it's not. Over the past 10 years, it's been growing at 38%, so it says, but really, I think that's a bit misleading. It's just had these really good 3 years recently, and that is really pushing it home. I really would like to know what happened in 2018 now. I'd like to know what they acquired or what they did in their business to make this good, and then why it really hasn't worked, why it's still declining at a ridiculous rate. 20% decline in 2019 and an 8.4% decline in 2020. I'd love to know what that was all about. It's obviously not COVID, because 2019 was pretty bad as well. So that's something I'd just like to look into if I was ever considering going into this company, because as I said before, this company is going to still be worth something, and it might be worth something to you if this is your sort of style of investing, if this real value investing style is your bag, because this company is currently trading under its earnings. It's currently trading about 40% below what we might call its fair value. So this might be something as a sort of sideways view to maybe look at. I'm trying to find a positive in this company really, but right now there isn't a lot. And analyst forecasts do suggest that you can still make some money with this company. If you go by analyst estimates, even though this company is still declining, you could still make 17% overall. You know, obviously Lumen has taken on some new marketeer recently and tried to really change the narrative and take it on this fourth industrial revolution. These are real Cathy Wood buzzwords going on here. It's really trying to change the image of this old ass technology company by bringing in much more robotics and going through, I'm imagining, Internet of Things kind of idea, really trying to make itself modern. But while the story looks really good, it isn't making money, and it would have to see a huge turnaround in its product for it to start making money. It can't just cut the dividend. If it cuts the dividend, it still doesn't make it profitable. This is why I don't think dividends really matter towards a company. If a good, profitable, growing company is paying a dividend, then that's a reason for a shareholder to be in the company. If a company with negative profit and negative free cash flow is paying a dividend, then you've got a real problem there. But it's not hard, as you can see with fast graphs, to find these kind of value trappy type companies. But again, it is worth something. If you wanted to buy today and bet on that future, there is a reasonable undervaluation here. The share price of this company is less than it's going to earn in the future. The only problem is, I guess, will more people not want to be in this company because they don't see that? And that would be too much of a risk that I really would want to take. Thank you very much for watching, guys. And if you enjoyed this video, please feel free to like, subscribe, and invest.
I'm amazed how many people own stocks. I'm amazed how many people own stocks. The sucker's going up.